I think that there's a lot of things going on that are not just the Fed, not just the PPI or CPI. I mean, we have world problems.
And then you throw in, Iranian attack of Israel is essentially imminent. And you have Ukraine now invading parts of Russia.
Which is nuts.
I mean, there's a lot of uncertainty globally.
Instability.
Hence why our 10-year treasury is sitting at 3.8 this morning.
So we'll get out of that before it gets too hairy.
Now back to our regularly scheduled programming.
Welcome to the Market Moment. My name is Matt Walters, and I'm joined today by Lee Mackey.
Hello.
And John Martfeld.
Hello.
And today we're going to talk about the Fed and the market. All right, so there's a lot to talk about, a couple good topics. But before we get into that, remember you can join the growing Market Moment online community by hitting this subscribe button. Give us a like, comment. We appreciate that. It goes a long ways, and we appreciate you guys listening. So we're going to jump in with the Fed. So the Fed didn't cut in July, and
as expected.
But the market's all in on them cutting in September. That's definitely what's being priced in. That's what the market wants. But Lee, you have a contact, a guy that you know that was on Fast Money yesterday, talking about kind of what his thoughts were.
Yeah, Phil Blancato, a guy I used to work with in Nashville several years ago. He now works for a Wall Street firm. He was on Fast Money, and they were picking his brain on the Fed and his thoughts. And I think he made a good argument for it that, the Fed should not lower rates in September. Not just go down 25 bips, but not at all. And his premise was essentially they haven't fulfilled what they set out to do. Their job isn't finished. Now, he's not talking about raising. He's just simply saying there's more work to be done. And the arguments that he made for it, were, I understood it. But he also did say that if they do not raise or do not lower rates in September, then the market will not be very pretty. September is typically a rough month anyway in the markets historically. And he said that, if all of a sudden the Fed comes in and says, we're not doing anything, then it could be ugly. Because I think a lot of the run up to this point has been with the thought that the Fed's going to do something. And to your point, what we were talking about before the podcast, it's not just that they get excited about 25 bips. I mean, the market now has pretty much gone all in on 50
bips.
Yeah.
But, going back to, and I've said this on this, how many times we talked about the Fed? Too many times, but it's a topic everybody wants to hear about because it's so in our face so much. But back when they started this rate hike cycle, the idea was to continue to raise rates until we had inflation back down to the 2% magic number. And it's never gotten there, even though it's gotten closer. It's come down. But it's never gotten to that point where they said, and if you remember back to that time, he was very strong in saying we will not stop raising rates until we hit this number. Mm-hmm. We're going, even if it pushes us into a recession, he made that comment. And so basically the fact that he's not raised rates in the last several cycles goes against what he originally said. But as we know, they can change their mind and
their how much of that is like positioning to, just him saying certain things.
And I think
hoping that has some impact, and maybe they don't have to actually do as much because of the positioning.
Well, I agree. But I think the Fed, we've been in this thing for a long time, and the historians of the market, the Fed in the last, really since 2008, has had way too much power, and we rely on them way too much. In reality, the market moves on profits and loss, right?
Yeah.
And the Fed movement of a quarter basis point here and a 50 basis point here is ultimately not as big as we make it out to be. With the idea that if they don't lower rates in September, because we have definitely baked it in that they're going to lower rates, but this is what it's doing this forever. This is what's funny about the market. The market bakes in things before they happen, right? And then when they don't happen the way the market bakes them in, it's a massive sell-off, right?
Yeah.
Same thing could be said about, it looked like Trump was going to run away from Biden, right? In the market, we had our all-time high shortly before they announced Biden was not going to run anymore. And then uncertainty was put back in the market, and poof, we lose, basically 10% on the NASDAQ and so on. The market likes its path to be very predictable, and when it's not, it kind of blows up. But this Fed stuff, this 25 bips, 50 bips, or nothing, is really not that dramatic in my opinion.
No, it'll create some short-term. It'll
short-term.
create short-term volatility, and I think if the market, Mike, where we sit today, if the Fed doesn't do anything in September, I think the markets
Not gonna like it.
will react in a negative way.
Well,
right? But that doesn't mean, sorry, Lee,
No.
that doesn't mean they sell off through the end of the year.
Sure.
Right?
Yeah.
Correct.
Like you could have
Yeah.
a couple weeks of,
Might create bargains.
but as long as profits and everything else are staying strong, then the
Right.
market's going to adjust.
Right.
I think that Chairman Powell has kind of painted himself into a corner with his comments. But if you look at the 10-year bond, it's backed up.
Sure.
And it's kind of taken a little bit of the pressure off of Powell because he hasn't lowered rates at all. But the 10-year has backed up, and it's below 4 now.
When you look at what really matters in the markets, right? The Fed funds rate dictates some of that. But to your point, sometimes the 10-year
Absolutely
gets out ahead of it.
Well, the 10-year is a signal too, though. More money flowing to that 10-year, which is reducing the rate, is more money. Is fear, in my opinion, in the market,
Sure.
right? Money flowing out of market into that 10-year to draw the interest rate down, which tells you that big money is worried about the market.
Well, and some of that though, I think you'll see some buying of the 10-year and even further out because of rate expectations, right?
Absolutely, yeah.
Yeah, trying to lock in
just
rates.
extending duration because the
Yeah.
last 2-3 years, how many times have we and has everyone else been buying short term, right? Keeping duration short because you didn't know how far they were going
Right.
to take rates. And now that we know, okay, we're kind of at the top from a rate perspective. I mean, people are, ourselves included, are adding duration because it's like, hey, lock this in while you can. So there's some buying on the 10-year with that.
And
There
that-
might be.
and that's what he said. They asked him yesterday, my friend on CNBC, what are you doing in your portfolios? And the very first thing he said was, we are buying well out beyond 10 years on fixed income. I mean, because we're taking the opportunity to do it. It's attractive.
Right.
Locking in those good
Well,
yields.
if you're a believer that the Fed can keep inflation around 2 to 2.5% for the long term, locking in 4.5 to 5%
Sure.
on a 10 to 15-year Treasury, while rates are going to probably be coming down over the coming years, for that part of the portfolio, it should, on paper, I mean, it should do what you need it to
Hey,
do.
on paper, we should be heading for a bond rally that we haven't seen in 15 to 20 years.
Yeah.
Actually.
If not even longer than that.
No doubt. Not even longer than that. Yeah.
I would say 20 years.
Yeah, 20 years.
It is interesting, all of this, talk about the Fed in September. I mean, it wasn't a month ago that we were wondering if we would get one in December, and now all of a sudden we're at a 50 in September. It's because inflation has cooled, at least the reports.
Yeah.
And all it takes is the PPI came out today, 1/10 of a point better than expected, but the CPI tomorrow is the big one.
Yeah.
I mean, if it comes in a little hotter than expected, then all bets are off, and so we're living week to week almost with reports that are coming out
And the
on
PPI,
economic.
just to define that, for most of the listeners probably know, but the PPI is the Producer Price Index, measuring the wholesale prices.
Correct.
It increased 0.1% last month. Most economists were expecting and forecasting a 0.2% gain.
Right,
So
right.
came in a little bit lower. Which
Came
was a
in,
positive.
which is better. Yeah. But if you go back like 25 years ago, before the internet, right, all of this data dump would be read in the Wall Street Journal the next day.
Correct.
You know what I mean? We are such instantaneous. Everything is just what's happening right now. It's really, the market doesn't really work that way. It's a long-term adventure, right? It's just amazing how we get caught up. I mean, we have to, because it's the way it is now, but it's also, and that's kind of the Fed stuff as well. Back in when I started, the Fed speaking very few, the bond department would watch what the Fed said. That was about it.
Absolutely.
Right? It wasn't that big a deal. I mean, they do things that matter, but it wasn't. It's just amazing how we've let it get.
What
so
happened a
big.
couple weeks ago with the unwinding of the carry trade, right? And we saw 2 or 3 days of pretty extreme volatility. I mean, the VIX spike. I mean, that's like a historically high VIX spike for a couple days. Monday, was that 2 weeks ago?
Yeah.
Yeah. Monday was a pretty decent little sell off for one trading session.
Yeah.
And the market came right back. And that's why you don't want to react to short-term volatility when the broader market still looks okay.
Right.
Don't
That
react.
was, it kind of started on Thursday, the week before. Then it really kind of got cranked up on Friday. And then you kind of knew it was going to happen. I mean, you have going into that weekend, people talking to their brokers saying, get me out Monday. And it was bound to happen. But
Well, and I'm afraid, I think that there's a lot of things going on that are not just the Fed, not just the PPI or CPI. I mean, we have world problems that have kind of been put on the back burner because we have all these other things internally that we're talking about, the election and so on. We have the election, which is going to be wild. It is no longer a runaway for Trump. It's now tight, and that is now an unknown. And so you have all these little things that are creating anxiety. And we've probably, in my lifetime, this is probably the most anxiety that I've felt from clients over an election in my lifetime. And it's some of it I agree with, and some of it is overreaction, right? So we know that historically speaking, Democrats, Republicans, whoever's in office, the market continues to move forward. It's based on corporate profits, period. Right?
Well, and then you throw in
they get hysterical.
And then you throw in, Iranian attack of Israel is essentially imminent.
Oh, yeah.
And you have Ukraine now invading parts of Russia.
Just nuts.
I mean, there's a lot of uncertainty globally.
Instability.
Hence why our 10-year Treasury is sitting at 3.8 this morning.
Exactly.
Yeah.
Exactly.
I had a fascinating conversation with a client the other day, learning a little bit more about her story going back. And this is talking about the election. And, she immigrated to America from a very socialist country.
Right.
And I just encourage you to go talk to someone who came from a different structure, economically and politically, who came to America for freedom.
Right.
And hear their story.
Yep.
And just see how that impacts you. Because I think it's oftentimes a lot of people, we can, and we're all guilty of it as humans, but take for granted what you have.
Put things in perspective.
You go talk to someone who grew up and spent a majority of their life in a different political situation, more of a socialist, communist society. They're not excited about what's transpiring in America and the direction that we're headed. And I don't know. I think it's I'll just leave it at that. But it's a good way to educate yourself and get outside of your little bubble when you talk to people who have different life experiences and could put things into perspective. Especially if you're on the fence of, you think you're leaning more towards voting for people who are pushing those certain agendas.
Well, I can tell you there's one WNBA star that was in the Olympics that took a knee in the U.S. and was really anti-American and all this stuff. Then she got arrested in Russia. I won't mention her name.
Yeah.
Got arrested in Russia for carrying pot in. Probably shouldn't do that. And then she came, she got freed. They worked hard to get her out. She goes back to America, and she was crying at the Olympics. She got her gold because of,
her perspective's a little
her
different
perspective
today.
has changed, right?
Yeah.
Tremendously. And that's good. It's not that's not what I wish everybody has to go through to get their perspective changed. But there's other famous athletes that say that Cuba runs their government better than the US. And I always say to myself, when you look at all the people coming across our border from all across Central America, South America, and then you look at all the unfortunate rafts and so on that capsize on the way from Cuba, trying to escape Cuba to get to America. And I always kind of say, I've never, ever heard of a raft capsizing trying to escape America to go to Cuba.
Yeah.
Right? And you don't ever hear about a large swath of Americans trying to cross the border into Mexico illegally.
Yeah.
You never hear that. Our country is awesome.
People
we just have to keep it that way.
People aren't coming here for handouts. They're coming here for opportunity.
For opportunity.
Yeah.
And so, anyways,
Anyway.
sorry for making that
No,
political.
that's patriotic.
It's
statement.
always
not political. It's patriotic.
Okay. So we'll get out of that before it gets too hairy.
Now back to our regularly scheduled programming.
So looking at indexes, I'm going to kind of rattle through index performance year to date. This is through August 9th, so just a few days ago.
Yeah.
So S&P 500 up year to date 12.96%, S&P mid cap 400 6.45, S&P small cap 2.4, The S&P Composite 1500, 12.3. You've got the Russell 1000, 12. Russell 2000 at 3.4. You got the Dow Jones at 5.9. The NASDAQ Composite at 12. So everything's up solidly, right? You look back and you're like, okay, 8 months into the year and everything's up, anywhere from 2 to 12%.
Right.
It's a good start to the year. You would take that. You would take that almost any
day,
all day and
right.
twice on Sunday.
no doubt. I'd take that forever. So think about that. S&P's up 12. Is that what you said? 12%. So historically, it's up through the first 7 months of the year more than it is annualized. For the first history. Yeah. I had a client come in yesterday, awesome, client we were talking about. They were worried because the market has taken these couple steps back in the last month, but they are not aggressively invested, right? They're moderately invested. We looked at their portfolio, and I pulled up our Orion reports, and they're up 6.5% year to date, even with the volatile last month. And we're supposed to get for them, according to our retirement plan, we're trying to get them 5.5% for the year. Mm-hmm. Does that make sense for them to survive? Mm-hmm. And the relief on the wife's face when I pulled that up and showed them, because obviously in the last month, there's been volatility. But if you look at it long-term, grand scheme of things, we're doing just fine. And year-to-date, we're doing just fine. That's when people call in screaming, scared, want to sell and so on. That's when people lose money. That's when emotions take over and you lose in this market, right?
Well, what I take away from the numbers you just mentioned is something that we've been telling, we've been saying on the podcast, the markets have broadened out, which it's healthier. The Mag 7, it's still the Mag 7.
Right.
But small caps up, mid caps up, values up, growth is up. I mean, it's, fixed income is up. I mean, it's right. You have to go pretty far down the line before you get to some things that are underperforming.
Yeah, well, on that note, so we're talking about so the market as a whole, right? A lot of these indexes are, we've talked about this in the past, but they're value weighted, right? So the largest companies in those indexes are making up a majority of the index, right? So biggest companies have the biggest weighting. So it makes sense. So as long as those big companies are doing well, the index is probably going to hang in there and do pretty well. But that doesn't mean everything's doing really well. When you look at the worst performing S&P 500 subsectors, so the S&P is made up of 11 sectors and 126 subsectors. You have the worst performing subsector is drug retail. Year to date, it's down 57%.
Wow.
Okay.
Led by Walgreens.
Yeah, I'm going to rattle through a few of these. Apparel and accessories down over 40. You have footwear, which is down just under 30. Household appliances down a little over 20. Casino and gaming down a little over 20. Automotive parts and equipment minus 20. Let's see. Hotel and REITs down probably about 15%. I'm kind of eyeballing a chart here, so this is give or take. Agricultural farm equipment down over 10, so probably 12, 13%. Passenger airlines down about 11, 12%. So the biggest sectors, so of the 11, the worst performing consumer staples, consumer discretionary. As a whole, you've got a couple industrials in there that are underperforming. But so it just goes to show that we get fixated and captivated by these big indexes because it's what you see on the news. It's it's how you kind of track the overall market. If you're passively invested, that's what you're tracking. I mean, that's how you're probably invested. But there's opportunity. You can look at this as either opportunity, underperformance, a couple different ways. But it just because the S&P 500 is up 12%, does not mean everything is doing well or having a good year.
Well, and that tells me that the consumer is struggling.
Yeah.
I mean, literally everything you mentioned there is discretionary spending. Clothes, shoes, travel, flying on planes, staying in hotels. I mean,
or consumer staple. I mean, it's consumer staples and consumer discretionary, but directly tied to, the consumer and consumer spending.
What was the NASDAQ up year to date again? 12%?
12 or 13. Yeah.
So NVIDIA year to date is up 65%. To your point about how overweighted stocks, which NVIDIA is still the highest rated is it still the highest? I know they got to the biggest, but so. Anyway, it came back a little bit. But NVIDIA represents 65% up. That's going to skew those numbers. There's going to be a lot of losers in there, as NVIDIA is a big part of that index, and then it's up 65. So to your point, sometimes it doesn't spread out, and there's a lot of people that are losing. And the other point you were making about the and I've always said this on the show, middle class and under are struggling a little bit right now, right? We can act like it's not there, but it really is across the country. Getting a home when you're young, when you're starting out. It was easier when I was starting out than it is for kids when I've got my first home. If you're 25, 30, it's harder now, and it's harder to get your food
getting
on the
a home,
table.
buying a car. Do you know what the federal student loan rate is right now? 9.5%.
Yeah,
I mean,
not good.
So, it wasn't long ago that it was 2% and 3%,
No doubt. Yeah.
and now it's 9.5%, 10%. And you think about it, 4 years from now, these students that are getting out,
Right.
they've got, this debt with
Massive rates.
interest rates.
Yeah.
I mean, that is a byproduct of these higher rates. So anyway, it's hurting a lot of people. Yeah.
And the kids that are going to college right now, all these kids that are going to college and graduating every year from all these schools across the country and fighting for jobs. The unemployment rate for 25 and under is actually really high right now. And we don't talk about that because the overall unemployment number is okay. It's actually pretty good if you look at it. But the 25 and under is really bad. And all these kids are getting that massive debt accumulated, and then they graduate and they've got 6 months to make their first payment, and a lot of them don't have jobs.
Yeah.
I mean, it's a little bit of a problem, and that will eventually leak into the broad market and take down companies, because obviously when spending stops somewhere, it's a snowball effect to the next level. At some point it's gonna catch up, and then it'll fix itself, and just like the market does, we go through cycles.
Yeah. Well, and this is where we've been through a period where, being broadly diversified, which is still I would advocate for long term, has hurt you in recent history. Right. Like that has led to kind of underperformance when you just compare to the S&P 500 or the NASDAQ. It doesn't mean that you're not invested in the correct way. It doesn't mean that's not how you need to be invested long term. It most likely is, but it can be frustrating when you see these index numbers and like, man, that's crushing it, and I'm not keeping up with that because you have exposure to S&P small cap value and S&P mid cap value and these things that haven't done as well. All of this is cyclical, right? Some of these cycles can last a very long time, which can be incredibly difficult, but it goes back to, we'll kind of end it at this, it goes back to knowing what are you trying to accomplish, how should you be allocated to accomplish that with the highest level of probability possible. And that rarely is going to mean we go by a handful of names that are crushing it in recent history.
No doubt.
And that leads to,
What's our tagline? Take the lowest amount of risk possible to achieve your goals.
Yeah.
We do a plan and we come out and it says you only need to make 5%, 6%, whatever on your assets to make it to age 100. Then we're not going to chase those things.
Right.
You don't have to. And to your point, if you're diversified out now, the other point you made about being, the broad modern portfolio theory has not worked, with the bonds and so on. And I think that's going to start cyclically moving back into where those portfolios might start working again.
Absolutely. Well,
the bonds are going to start.
as a
working.
firm, a firm, we've done it. We didn't have a large allocation at all to fixed income for the entire history of the firm.
Right.
Going back to 2005, and we now have a good amount allocated to fixed income.
No doubt.
Because it makes sense. So you have to be willing to adjust and learn, and with the environment that you're given, invest appropriately. So really good conversation. I don't think what we're talking about today will go away anytime soon. So,
we could just repeat the same conversation a week from now.
No doubt.
But CPI comes out tomorrow.
That's a big one.
That is a big one for sure. So if you like the episode, let us know. Click the like button, give us a subscribe, give us a comment. We appreciate you guys, and we'll see you next week.